My name is Bill Starnes, a senior advisor at Mallard Advisors in Hookessin, Delaware. This graph from JP Morgan Asset Management is one of my favorite perennial graphs to express a key point, that long-term investors should not overreact to short-term volatility. The bars in the chart show the price-only return of the S&P index for each year since 1980. The dots show the biggest peak-to-trough decline that occurred within each year. Let's call them stock market corrections. The dots are inevitable as the market does not move in a straight line, so each year will have to contain some correction. In fact, the average intra-year peak-to-trough decline in the last 36 years has been 14.2%. When the market is going through one of these corrections, it is painful. It's painful to see market values drop, which then brings worry and even wonder if it's time to abandon stocks altogether. However, the reality is that in 27 of the last 36 years, which is 75% of the time, the market still ends up positive for the calendar year, even though the average annual end of the world is 14.2%. In 2008 and 9, it was the financial crisis. In 10, it was the flash crash correction. In 2011, it was the debt ceiling, then the fiscal cliff, then Greek debt crisis. In 2013, it was the government shutdown. In 2014, it was Ebola. In 2015, it was terrorism in Paris and California. But even in light of all of these terrible events, U.S. stock investors saw very good returns over these times. Even with all the problems, we have not seen a correction greater than the average correction of 14.2% since 2011. We've actually had it pretty good. That doesn't necessarily mean it's going to get worse, but it doesn't mean it won't. The message of this page really is that history is strongly on the side of those who don't overreact to market corrections. Because as you can see, the corrections are always worse than the calendar year returns. This is why those who don't overreact to short-term volatility are able to capture the positive expected long-term returns provided by the stock markets. Thanks for listening and have a great day.